All right, let's get started here. I want to be respectful of everybody's time who is on. So we are going to keep this to hopefully under an hour. That is the goal. Cover a lot of material, and so we will move fast, but we encourage questions throughout for sure. So thank you for joining us today. I am Jason Dahl. I am a certified financial planner and the director of financial planning at AFS. And I am here today remotely, of course, with my colleague, Al Adabek, the founder and managing partner of AFS. I know we have a lot of individuals tuning in from the what we call the 401k side. So I wanted to just give a quick reminder that our financial group team is the sister entity to AFS 401k Retirement Services. And although we work closely with each other, we are two separate companies and operate as such. Now, we at the financial group team helping individuals in their wealth management journeys, and the 401k team servicing corporations and their participants in regard to their employer-sponsored retirement plans. And today we will be discussing understanding your benefits, which is one of our newest presentations that we are excited to bring to all of you. A couple of things quickly before we get started. Just a reminder that we are recording this session and we will be sending the recording out within the next few days, along with the accompanying handout for this presentation. And lastly, as I mentioned just a moment ago, please ask questions at any time during today's session. You can ask a question by typing it into the Q&A or chat boxes. They should be located on kind of the control panel. There's a little pop-up box for Q&A or chat. Either one works. You can just type in a question. I want to say that one of our favorite questions is, can I schedule a time to speak with you, Jason and Al? and yes, we encourage you to directly follow up with us after this workshop if you have further questions or would like to schedule a time to review a few things over Zoom or just an old-fashioned phone call. We love what we do, and the best part of what we do is connecting with people and helping them solve their personal financial planning puzzles. So please don't hesitate to reach out. So without further ado, let's get into it. For any of you who have tuned into some of our presentations and workshops before, this may be familiar. This is our hierarchy of financial needs. And really, I'll say it comes from the most common financial query we hear that fall under the umbrella of one major question, and that is, what should I be doing with my money, right? And this very comprehensive question inspired us to create the hierarchy of financial needs. So the hierarchy serves as the framework of our financial wellness program, and we use this hierarchy to help individuals properly prioritize their financial lives. Before exploring this hierarchy, it's always important to first know what your current financial situation is. So take some time to review your monthly spending to ensure you know where every dollar you earn is going. All right, life happens, things move quickly, and before you know it, there's just a lot of what I like to call leakage, right? You just say, gosh, where's all the money going every month? So it's always a really good, thing to do periodically, at least once a year, I would say, right? To maybe print out that credit card summary that all the credit card companies provide, and look through that and just understand, hey, where's the money going every month? So once you have a sense of your current financial picture, think of our hierarchy as kind of your linear roadmap to financial success and independence. And our hierarchy begins at the bottom, okay, with the most important or foundational needs, and considered the highest priority, right? And then with each step building on the previous one until you reach the top. And I will say that everyone is currently somewhere on this hierarchy. All of us are. And ideally, you want to fully meet the goals of one level before moving up to the next rung. However, we recognize that life doesn't always allow you to move in such an orderly fashion. And a lot of us probably have, one foot on one level and another foot in a different level at any given time. So after successfully making it through the hierarchy, you may find yourself needing to revisit certain steps to make adjustments and to account for any changes to your financial life, right? That maybe salary increases, job changes, new expenses, living costs, right? Just to name a few. But as we go through the rest of today's presentation, we will kind of reference back to the hierarchy, because a lot of the benefits and things that we're going to talk about are on this hierarchy. Such as HSAs, or health savings accounts, within the context of healthcare plans through your employer benefits. So let's let's talk about that. I will also add, in addition to kind of healthcare and insurances, we'll also talk about retirement benefits and touch on a few other common benefits. So we'll talk a little bit on health insurance, with HSAs, right? Life insurance, disability insurance benefits, retirement benefits, and a few others. All right, so starting with healthcare plans. So today's workshop, we will dive into health savings accounts, right? And whether a high deductible health plan with an HSA, all right? So I'm going to use the acronym HSA a lot. So we're going to be referring to, that refers to health savings accounts, all right? So we're going to talk and hopefully help you better understand whether a high deductible health plan that has an HSA attached to it may or may not be right for you and your family. I will say we're not going to really go into the specifics of various health insurance coverages, for example, whether an HMO or a PPO is better for you or your family. That is a whole nother ball of wax and a whole separate workshop that just focuses really on health insurance and Medicare, I'll say. All right, so here is a simple chart to illustrate kind of the financial differences between what I'll call a quote-unquote regular health insurance plan, or in this case, an HMO plan, and comparing that with a high deductible health plan that has an HSA attached to it, okay? So we often encounter folks who don't necessarily fully understand what a health savings account is or how it works, and who don't know if their coverage options even include an HSA eligible plan, okay? HSAs are a type of savings account that, if you are enrolled in a high deductible health plan, allow you to save money on a pre-tax basis to pay for qualified medical expenses. All right, so put another way, HSAs are, think of them like a personal savings account, but the money in them is used for healthcare expenses. All right, and you, not your employer, not the insurance company, own and control the money in your account. All right, the money you deposit into the account is not taxed, and we will get into the tax benefits more in a moment. Back to this chart. So hopefully this chart will help give you just a basic, give you a grasp of the basic concept of comparing kind of the potential out-of-pocket costs, right? And then that's really kind of where it all begins, right? Comparing what again, I'm going to refer to kind of a normal or regular plan, the HMO plan on the left-hand side there, with a high deductible health plan, right, that has a HSA attached to it. All right, and we really want to kind of emphasize the importance of funding an HSA if you're enrolled in a high deductible health plan. Okay, so just kind of walking through this chart, again, this is a very, very simple example, right? The sort of the traditional HMO, this example has an annual premium of $76.92. The high deductible health plan has an annual premium of $58.80, right? Because it has a higher deductible, it's going to have a lower premium. Okay, hopefully that makes sense to everybody. But then we're also showing, okay, if you have that higher deductible, now you can fund or save money into that health savings account, right? So we're sort of equalizing the annual sort of out-of-pocket costs for premium and savings, okay? So getting them both to the $76.92 in this example. All right, come down a row there, you see the annual deductible on the HMO is $1,000. The annual deductible on the high deductible health plan is $2,500, okay? So let's just imagine a scenario where you had enough healthcare needs, right, where you met the, you were, spending money out of pocket, eating away at that deductible. So in the HSA example, you can use the money that you got a tax deduction for putting into the HSA, and then you can pull it out now tax-free to help cover those costs for those out-of-pocket expenses under the high deductible health plan. Hopefully this is starting to make sense for folks, but we're going to spend a little bit more time diving into the HSAs and really kind of how they work. So I think one of the first things we should do is take a moment to compare HSAs with their cousins, the FSA or flexible spending account, and HRAs or health retirement accounts. I will say that we don't really see a lot of the HRAs anymore. If somebody has one and wants to reach out to us with questions, happy to kind of talk more about that, but we're gonna kind of gloss over that and really focus more on the FSA and HSA. But really kind of the most important sort of distinguishing factors between any of these three plans are really around who is eligible, right, who can contribute. If the funds are portable, right, if you can take them with you, if the funds can carry over from year to year, right, those are all important differences. And if any of you have participated in FSAs, you're kind of you have some familiarity with what I'm talking about here, right? So for example, employers can contribute to an HSA, right, along with the employee. HSAs are portable for the employee, I mentioned that earlier, and of course the funds carry over from year to year. Okay, so I will also add, within an HSA, you have the ability to invest the funds, kind of similar to like picking the investments in a 401k plan. So I'm going to turn over to Alp here for a moment. He's going to share with us a little bit more on flexible spending accounts through our employers.
And good morning, everybody. So difference between HSAs and FSAs. FSAs are flexible savings accounts, flexible spending accounts. They're pre-tax savings accounts, and there are two types, medical and dependent care. Medical is very similar to an HSA, but it actually has one big difference, and it has a use or lose rule with it. In other words, you have to be careful not to overfund the account. If you don't spend all the money, you potentially are going to lose the money. On the dependent care side, it's typically more valuable than dependent care credits that are available on your taxes. But like the credit, you need to pay for qualified child care expenses with the money, and that means licensed daycare providers. Like a few facts on the medical FSAs. FSAs are limited to $2,750 per year per employer. If you're married, your spouse can put up to $2,750 in an FSA with their employer too. And you can use the funds in your FSA to pay for certain medical and dental expenses for you, your spouse, your family, and your dependents, etc. You have to basically use it from, I'll say, a qualified list. And so once you enroll in an FSA, you will get sent a list of eligible expenses. So you can pay things like deductibles and co-pays, crutches, braces, etc. All that, it will all be on the list. FSA limits, grace periods, and carryovers. So generally, you must use the money in your FSA within the plan year, but your employer can offer one of two options. It can provide a grace period of up to 2.5 extra months, and this is generally the only thing I used to ever see back in my tax days. And so you have 2.5 extra months at the end of the year to spend the money that you put in your flexible spending account. For example, in the year 2020, you had to have the money spent by March 15th. Or it can allow you a carryover of $550 per year to use in the following year. Never saw that. Your employer can offer either of these options, but not both of them. When it comes to the dependent care flexible spending account, that's money, again, you're putting in pre-tax, and one of the benefits, again, it's not subject to payroll taxes, and it's used to take care of child care expenses. You have to have qualifying child care expenses. Your child has to be under age 13. It's for before and after school care, babysitting and nanny expenses, daycare, nursery school, preschool, summer day camps. They can all qualify, and you can also pay for adult dependents. So if somebody has a spouse and they actually need care right now, you can use that for if you're basically going into an adult daycare center. Jason?
Oh, all right, thank you. Making sure I was unmuted here. All right, so let's transition back here a little bit on HSAs. Touched on some of this already. Just want to make sure we're clear on kind of who is eligible to begin with. So if you are covered under a high deductible health plan, you can contribute to an HSA. Now the IRS actually defines high deductible. Okay, so for 2021, the deductible must be at least $1,400 for self-only coverage, okay, or $2,800 for family coverage. The IRS also sets limits on out-of-pocket expenses, so a cap, right? So the plan cannot exceed $7,000 of out-of-pocket expenses for self-only coverage, or $14,000 of out-of-pocket expenses for a family. You must not be enrolled in any other plan or be a dependent on someone else's tax return. So remember, having a high deductible plan means you are going to pay more money out of pocket before your medical coverage kicks in. okay? Your upfront costs will be higher whenever you use your medical coverage during the year until the deductible is reached. I'll say probably the most common example of someone using an HSA is someone who is relatively healthy and is a low healthcare user, right? The idea that you're not really going to tap into that deductible, right? So somebody who just typically sees the doctor for regular annual checkups, thus they don't typically spend much out of pocket towards their deductible. A common misunderstanding, I think, with high deductible health plans is they allow you to still go for your regular annual checkups, right? Now, for both men and women, you can go do your the important sort of physicals and essential checkups that are needed, and those actually don't count towards the deductibles. That's an important thing to remember. All right, so let's talk a little bit about the tax benefits. Maybe what makes HSAs so popular among financial advisors. And I know this slide says triple tax-free. I am going to get a little technical on you and actually share 4 official tax advantages of health savings accounts. First, 100% deductible on contributions up to the legally mandated maximum amount, regardless of income. Okay, so some of you may be familiar, right? There are income limits on contributing to a Roth IRA, for example, and other kinds of retirement accounts. There's no income limits on contributing to a health savings account. Withdrawals of your contributions, if they come out for qualified medical spending, they never fall under taxable income, right? So you get a deduction for the money going in, and if you pull the money out to pay for qualified medical expenses, they don't get taxed on the way out. While the money is inside the HSA, it's tax deferred, right? So if you have investment growth or interest earnings, all of that is tax deferred while inside the HSA. And then withdrawals of any of the investment growth or the interest earnings also come out tax-free, okay? So that's kind of the 4th technical benefit. So if I were to simplify it, you get a deduction for putting the money in, and so long as you pull the money out for qualified medical expenses at any age, the money comes out tax-free. All right, so let's sort of talk about one important sort of age threshold regarding distributions from an HSA. So as I mentioned before, both contributions and any investment or interest earnings will come out totally tax-free for qualified medical expenses at any age. Okay, that hopefully is drilled in at this point. If, however, any portion of a distribution is not used for what is considered a qualified medical expense, that portion will be included as taxable income and subject to a 20% penalty. All right. One other however here. Once you reach age 65, you can take penalty-free distributions from the HSA for any reason. Okay, so the distribution, if the distribution is not for a qualified medical expense, then it will just be taken out and taxed as ordinary income. So think of it similar to, right, like a traditional IRA or traditional 401k contributions, right? That you got a deduction going in, but at age 65, if you take it out, and here's where it can be used as kind of an excellent supplemental retirement account, right? So we work with a lot of folks who have been able to fund an HSA and didn't need to draw it out, right, to pay for medical expenses for many years. So they've accumulated a nice balance, and you can sort of think of it as kind of a supplemental retirement account once you get to age 65. And this is probably, I'll say, the second most common example of someone using HSAs, and that is perhaps later in your career. Maybe kids are off the family payroll, they're off the family health benefits. You're still relatively healthy, right? Relatively low user of healthcare, and you're thinking that you're going to retire and not have employer coverage before reaching age 65 in Medicare eligibility. So this is also another kind of strategic way of using the HSA plans to build up the HSA balance. Then you can use that HSA money to help cover out-of-pocket medical expenses before you get to Medicare eligibility. All right, so you want to emphasize an important a point here with HSAs. The funds in your health savings account are always yours to keep, regardless of your employment status or insurance coverage. Okay, so this means that if you change your job or if you change your health plan, you keep your HSA, right? It's your money to spend on qualified medical expenses as usual, right? So even if you've changed plans, you're no longer in a high deductible health plan, you're now on a quote unquote normal deductible, health plan, you can still use the money in your HSA to pay for any out-of-pocket qualified medical expenses. All right, so let's talk a little bit about the mechanics of funding HSAs, right? So some employers will offer the ability to kind of have payroll deductions going into the HSA, right? And even, as I mentioned before, even some employers fund the HSA. However, right, and if they're doing payroll deductions to the HSA, right, that you're going to get the tax benefits similar to, right, like payroll deductions going into your 401k, right? It's just going to reduce your taxable income. But for a lot of other folks, they may be eligible for an HSA, and the HSA isn't sort of built into their employer structure, right, for payroll deduction, and so they fund it themselves outside of their employer infrastructure. And in that case, right, you can have an independent HSA account. You'll just need to, on your tax return, indicate, hey, I funded the HSA. Let's say I'm an individual and I've max funded it of $3,600 at the limit, right? You just write that in to take your deduction on your tax return. All right. So as I just mentioned, for 2021, the maximum that an individual can fund into an HSA in a year is $3,600. For families who are on a high deductible plan, you can contribute up to $7,200 into an HSA. And there is a catch-up contribution similar to, right, 401k and IRAs, but this is at age 55. You can do an additional $1,000. All right. Important thing to remember, these limits are total combined employer and employee contributions to the HSA, right? So if you have an employer who contributes, I'm just going to say, $1,000 a year, then you can only put in $2,600, right, if you have individual coverage. Another really important note is HSA contributions, the eligibility and the limits are kind of pro rata. Okay, so think of it like if you want to get a full year's worth, you would need to kind of be enrolled by December 1 of the prior year, and then be enrolled in the high deductible health plan for the whole subsequent 13 months in that example, right? So December and then January through December of the next year to qualify to get the full $3,600. Okay, so if you're only enrolled for half of the year, well, then you can contribute half the $3,600 or $1,800 into the HSA. Al, I know you already talked about the FSA limits. Here they're just on the screen, so I won't belabor that. We'll keep this train moving. All right, so shifting gears a little bit, and here's another, right, kind of common benefit that a lot of employers offer is different kinds of insurances, right? So let's first talk about life insurance, and I'm going to first kind of talk about life insurance in general, right, and kind of understanding the needs for life insurance, and then we'll kind of drill into how to best coordinate that through coverage through your employer, right? So hopefully everybody is familiar, right? Life insurance is most commonly used, right, to protect against the loss of current and future income, right? If something were to happen to you or your spouse or loved ones, right? Anyone that you're kind of financially responsible for, or vice versa, right? So one sort of common guideline or simple rule of thumb when thinking about how much life insurance you need is think of it as like a family would need 75% of the lost income upon the death, right? If I were to pass away, 75% of my income or 75% of my spouse's income. Why 75%? In large part, it's because while I'm working and earning, my income is taxed, right? So I'm not actually keeping 100% of my income, right? I'm getting after tax. Whereas life insurance proceeds pay out and come in tax-free, right? So that's kind of the main reason why why you're not kind of trying to replace 100% of your pre-tax income. All right. So now, some of the other biggest variables that people think about are sort of debts, right? So mortgage being the big one, and education funding. All right. So when you're thinking about how much life insurance coverage you need or want, is kind of those three variables you think about, right? Okay, 75% of the lost income. All right, and there are a lot of free life insurance tools online that you can go on to and just type these in. But the basic gist is they're just going to say, okay, how many more years do I expect to work? What's my income, right? Sort of multiply those two, right? Take 75% of that income, multiply it by the number of years I still expect to work. That's sort of one number, right? Sort of lump sum consideration. How much debt do I have, right? What's the mortgage balance? Because a lot of people say, hey, if something were to happen to me or my loved one, I want to be able to pay off the debts. And then the other variables, a lot of people think about, hey, if you're saving money for college for kids or perhaps even grandkids or others, a lot of people say, well, gosh, would I or my spouse or loved one be able to continue to save to pay for college at our goals? So those are sort of the three variables that go into for a lot of folks thinking about how much life insurance to get. Okay. And there are a lot of different types of life insurance, right? We have, I'll note, we have a whole nother presentation just on life insurance. All right, so we are kind of just skimming the surface here, but really the simplest way to think about it is one of two forms. There are temporary or term life insurance policies, or there are a whole bunch of different types of permanent life insurance policies, okay? And under that permanent umbrella, it just as the name implies, right? The idea is having the coverage in place no matter how long you live, right? But there are a lot of different flavors there. Some of them have savings components to them, right? So for every premium that you pay, a portion of that premium goes to the cost of having the life insurance, and a portion of it goes into a form of like a savings account. Now, whereas the term policies are temporary, right? So a lot of people will buy a policy for a 20-year term or a 30-year term, for example. And in the vast majority of cases, there's no sort of saving component to that, right? So they're going to be the lowest cost, right? Because you're just paying for the cost of having that coverage, okay? The right type of policy isn't cookie cutter, right? It really depends on your specific situation and the needs of you and your family and your financial plan. Similarly, right, disability, another really important kind of risk management tool to think about, right? So just like where life insurance is there to replace lost income in the event of someone passing, disability insurance is there to help replace lost income in the event of someone being disabled and being unable to work, right? Disability insurance really simply broken down into sort of two types primarily, short-term and long-term. Short-term basically just means that the benefits paid would be paid for a maximum of generally like 3 months. Whereas long-term disability benefits would be paid for what we most often see is like to age 65, right? There are different flavors, but that's generally the most common that we see. So for example, if you think back to the hierarchy earlier, so if you have strong emergency savings, right? So you've got enough to cover if you were out of work for 3 months, right? Let's say you were injured, you weren't able to work, you lost your income for a 3-month period, but hey, you had strong savings to be able to cover that. Then you might say, I don't actually have that big a need for short-term disability insurance. Other folks still say, I still want that protection in place. But that's kind of the thought process to going into it. But I'll say pretty much everybody really should think long and hard about having long-term disability insurance, right? And that's right. Again, just if you're unable to work for really kind of the rest of your working career because of some sort of qualifying disability, then the long-term disability kicks in. Okay, so a few key points to think about here is you want to think about, okay, what would the monthly benefit amount be? Okay, disability insurance pays only a portion of your normal earnings. Okay, it's not a full replacement. So typically it's about 60% of your earnings that gets replaced through disability benefits. You also want to think about, when do the disability payments begin? Okay, sort of like a deductible period there, and sort of what are the qualifying events, right, for the policy to kick in. And then the other big one is, well, would my disability benefits be taxable to me or not, right? Because if they're going to be taxable to you, then you need to take that into account, because okay, if it's only replacing 60%, but then it's going to be even less than that if they're taxed. And so disability benefits will be taxable to you if the premiums were paid for by someone else, like the employer, right? So if you have employer-sponsored, employer-paid disability insurance, then you need to recognize that, hey, if I go out on disability, those benefits are going to be taxed to me. So you may want to go get a supplemental policy on your own where you pay the premiums, okay? And that's, we see that a lot, kind of complementing one another, having some employer-provided coverage as well as some coverage that you pay for yourself. And when you pay the premiums yourself, those benefits would come in tax-free. All right. All right, so now kind of specifically within sort of the confines of your work. Also, we often hear from folks who say, whether we're talking about life insurance or disability insurance, right, that kind of risk management conversation, a lot of folks will say, I'm good, I have coverage through work, so I'm all set. Our typical reply to that is, well, that's great, but, okay? And as I was just talking a little bit about, typically coverage through work alone for life or disability insurance is generally not going to be enough, okay? And hopefully you're kind of getting a sense for that from what I've been talking about so far. So, group life insurance through work is typically limited to maybe 1 to maybe 3 times your salary, okay? So if you're expecting to work more than 1 or 3 more years, right, that can kind of be a simple, sort of red flag to say, hey, my coverage through work alone is not enough. But also, right, your coverage through work is generally not portable, right? So if you let's just say you took a break, but then you went, you went and got a new job, right? Though there'd be gaps in coverage, or maybe you went out and you were self-employed, and so now you have no longer have any coverage, right, through work. So I'll say it's not uncommon for folks to kind of start with a multiple of 10 times your salary. Okay, again, this is just painting with a broad brush, but just kind of, I know some people like to sort of start to think like, oh, okay, well, if I make X, what's just a really quick way to think about it, right? Oh, what would 10 times that be? Right? That's also another way to kind of get a quick sense. Another important point is group coverage, right? Coverage provided through your work, kind of assumes that everyone under that coverage, everyone in, right, all your coworkers, is of average health, right? Because they're providing coverage to everybody without going through kind of underwriting, right? Without looking at each employee's specific health status. So for some folks who may be, I'll just, use broad terms, say above average health, you're probably going to be able to get better pricing by going outside, right, and getting it on your own. If you're below average health, and that can for a lot of different reasons, right, the cost may be better through your employer, right? So you may want to look into, okay, is there additional coverage through my employer plan that I could leverage, right, and buy more of that through work. Okay. Let's see. I already talked about the tax benefits on disability. Al, anything else you'd kind of
Well, I'll just say
add there?
on the life insurance coverage for somebody 55, 60 years old that is actually going through work, what are you seeing the differences in premiums if somebody's in good health? I'm not asking a specific dollar amount, but is it substantial if you were to go out on your own, if you're in good health or excellent health?
Yeah, I'll say it's worth your time. It's definitely worth your time to compare it, because you're going to find that, oh, this is you use the term substantial, I think, in the vast majority of cases, right? If you're right, if you let's just tie it back to the HSA conversation, right? If you're in good health, you're a low healthcare user, you've been in high deductible health plans funding HSA, well, that's probably a pretty good sign that you're going to qualify for much better pricing for life insurance outside of your employer coverage. Yeah. So let's talk a little bit, kind of wrapping up here on the kind of health and disability, just kind of best practices, right? So like many things that we've talked about, it's really good to review them periodically, right? Life changes, nothing stays static, right? The only constant is change, right? And insurance coverages are no exception, right? So let's just say, right, you got a promotion, now you have a lot more income to protect, right, or to hedge against if that were lost. But sort of on the backside, right, as I mentioned, good example here with disability insurance. A lot of policies will only pay to age 65, and so somebody might be 64, let's say, and so in those cases, they might say, well, they'll only pay to 65 or for a 2-year maximum, right? So obviously some people work beyond age 65. So you might have a disability coverage still in place when you're 65, 66. But at that point, a lot of those coverages will have max benefits of 2 years. And you might say at that point, oh, you know what? I'm really mostly working because I want to, let's just say. Hopefully, right, we can all get to that point where work becomes optional. And you may say, you know what, I'm good. I don't need to keep paying for the disability coverage, right? There's not the big risk to protect against, right? So there becomes a time where you may want to, roll back or peel off some of the coverages. The other thing I will say is it's really good to review your coverage once with a professional, right? To kind of somebody who can help you, kind of understand. All right, am I thinking about this the right way in terms of the amount of coverage to have, the right types of coverage, right? Is term insurance better for me, or having permanent coverage, or maybe some of both? I will just mention, don't get stuck in what we like to call analysis paralysis, right? Don't lose focus on, oh, you know what, the most important thing is having some protection in place for me or my spouse or my loved ones. And so for a lot of folks, the best thing is, hey, get a term policy in force right away. So you've covered that most important risk, right? That's going to be the lowest cost, kind of the simplest to understand. And then you might go and say, oh, does it make sense to kind of complement that with a different form of permanent coverage, or that has a savings component to it. Alp always likes the John F. Kennedy line, right? That says, the time to replace the roof is when the sun is shining. I think that's a great line when thinking about insurance too, right? Like, get coverage in place while you're healthy, right? One of the risks of waiting is something changes in your health status and you become, worst case, completely ineligible for coverage, right? Or the cost just goes way up. The cost for coverage is always going to go up just for getting older, right? But then we run the risk of things changing in our health, right? Which would also result in higher costs. All right. So let's shift gears.
Sure. So how does your retirement plan at work? How does your retirement plan at work work? And probably the best description is going into your summary plan description, a very useful document. If you tried to read, I'll say, the full document, it'd be pretty difficult to understand everything, but the SPD, as it's called, is very simple, very straightforward, written in plain English. Generally talks about eligibility, entry dates, automatic features, employer contributions, a vesting schedule if there is any, and a default investment. And what that means, eligibility is like, what do you have to do to get into the plan? A lot of times it might be you have to work 1 month, 2 months, 3 months. You might have to be a full-time employee, which is defined as more than 1,000 hours a year. There are now some more lax rules for, I'll call it, long-term part-timers. So if you fit that definition where you, let's say, only work about 800 hours a year, there are actually some new rules that allow you to get into the plan as a part-time employee, which is very helpful. I think that's a great change that they made. Entry date is once you've met the eligibility, when do you get in? So for example, if you met the eligibility on March 15th and the entry date was on the first day of the month on the following month, then you would get in on April 1st. So that's fairly straightforward. Automatic features, this is something that's been really popular over the last 5 to 10 years. We're seeing more and more plans adopt automatic features, some great psychology to it. It's basically built on that you have to opt out if you don't want it. And what that means is if it has an automatic feature that you're in the plan, essentially when you meet the eligibility, you will get signed up for the plan. They have another really cool feature these days, auto increases, where some plans will automatically increase the amount of your contribution by 1 or 2% per year until it gets to a certain threshold set by the plan. And again, the psychology is amazing. People tend not to do anything. They just assume it's like another tax. They don't realize that their contribution has gone up. So we really love these automatic features. And if you don't want them, you have to proactively opt out. Employer contributions are exactly what they sound like. That's what your employer is putting into the plan. And the most important thing to realize, to get the employer contributions, if there's a restriction that you have to put in 6% to get the employer's 3%, one of our big rules is you always take the free money. So even if you're struggling financially early in your career with student loans, whatever it may be, we want you to try to take advantage of the free money.
You'll see that on the hierarchy. Sorry, interrupt
absolutely.
you.
Yeah. And a vesting schedule is not for the money that you contribute into a plan. It's based on a vesting schedule for what the employer puts in. And sometimes the employer money could have a vesting schedule of up to 5 years, meaning that if you were to leave your employment after 3 years, you might only be 60% vested in it on their contributions. You're always vested on your own money, your own salary deferral into the plan. Default investment is fairly straightforward. If you don't proactively make a selection on how you want the money invested, it'll invest it for you. It's in the plan document. Typically these days, the money will go into a target date fund or an asset allocation fund automatically. So if somebody's to retire in 20 years, they'll pick a target date fund that would align to retiring in 20 years. Next slide. So we hear the term 401k, 403b, thrift savings plan, 457 pension plans. So the top three are basically, I'll call it the same thing. They're salary deferral programs where you take a portion of your salary and defer it into the plan. There's limits on how much you can put in. 457s are similar to that. It would be a salary deferral, but there are some employer provided 457 plans. Pension plans are different. So you don't see them as often today as we've, I'll say in the past, where Jason's father worked for the government for how many years, Jason? 40 years or so?
Yeah, 43.
43 years. And so he gets an automatic check every month after he retired of a certain portion of his prior salary. So pension plans are different. It's basically employer funded. However, a lot of pension plans, specifically government pension plans, you're required to put in a certain portion of your pay into the plan. My wife works for Montgomery County Public Schools. She's actually required to put in 7% of her pay into the plan. So not only will the government chip in and put money into the plan, she's putting money into the plan. Next slide. So how much should you be saving? So we have an entire presentation on retirement funding that goes into this question in detail. We'll discuss like your current retirement savings, future contributions, your employer contributions, your retirement income needs, life expectancy, when you're going to retire, etc. All that goes into it. So for now, we're just going to say, to simplify things, if you're just starting out, we recommend that you contribute at least 10% of your pay into a retirement plan. And if you're starting later, that means you're going to have to, if you're going to try to play catch up, you're going to have to put more than 10% into the plan. And, one of our longtime office jokes is, we've done this for me, I guess longer than Jason. I've done this for 30 plus years. To date, I've never met anybody that basically wishes, or anybody that basically felt they saved too much money for retirement. Everybody wants more in the retirement savings. So next slide, we'll talk about the limits. For people that are under age 50, you can actually put $19,500 into the plan. If you're 50 or older, they have catch-up contributions, so you can actually save $26,000 into the plan. Some people have both, like for example, like Montgomery County Public Schools, they have both a 403B plan and a 457 plan. And in those situations, you can actually put money in both of them up to the limits. It sounds unfair because not all companies have that ability, but it's interesting. If you have somebody that that actually has two different plans they can go in, it's really beneficial for people that have paid for all their kids' colleges, where they've gotten to a point in life where they're just saving a lot of money, to be able to put more money away pre-tax. It's really just a huge benefit. So to Roth or not to Roth, when I started in the business, basically we all did pre-tax contributions into retirement plans. And so that meant if your salary was $100,000 and you deferred $15,000 into it, your W-2 would say $85,000. Today, you can put money into an after-tax, a Roth 401k contributions. Most plans have this feature, and that means that there's no deduction for putting money into it. But the trade-off is the money that's in a Roth 401k will grow totally tax-free for the rest of your life. When you pull it out, it will come out totally tax-free. The traditional 401ks, you put the money in, as I mentioned, pre-tax, that money will come out taxable. Hopefully you'll be in a lower tax bracket, but you've got to weigh the benefits. We look at it as a form of tax diversification. So, if you're in a situation where you've fully funded for retirement and you don't know what the tax rates are going to be down the road, you might consider starting to fund basically into the Roth 401k, so you're not getting a deduction for it, but that money basically will grow tax-free. One of the other benefits of the Roth 401k, when you pull the money out, as I said, totally tax-free, but you don't have to pull the money out at age 72. In a traditional 401k, you have to pull the money out. You have to take required minimum distributions once you turn 72. Retirement readiness, as I mentioned, if you basically are completely funded, you want to put the money into the Roth if you can. For somebody that's really young, like our staff in our office, we've got 3 or 4 people that are in their 20s and early 30s. In that example, all of them are actually taking advantage of that long-term retirement time horizon. They're putting all of their contributions in Roth. So that means they're not getting any benefit tax-wise, but that money in their scenario could potentially grow for 40, 50, 60 years without income taxes, which we think is just a huge tax benefit.
And you can split it.
Absolutely.
You can do some in the Roth and some in the pre-tax. I know that's what I did for a number of years. I did 100% Roth contributions for a while, then I was splitting it for a while. Now I'm doing it all pre-tax.
And again, you kind of like work through the tax benefits of doing it to decide what the best path is for you.
Yeah. So Alp, we had one question. Do you have that there in front of you? I want to make sure we address that before we kind of keep moving on here.
We had one question that talked about the potential to lower your adjusted gross income. And, besides putting money in 401k plans, et cetera, not many options these days. I would tell you probably one of the easiest options, if you qualify income-wise, is actively managed real estate can give you some tax benefits that would lower your adjusted gross income. But again, there's phase outs on if you can write off a real estate loss on your taxes. And that phase out means like once you get above a certain income level, you can't take this benefit. So if you invested in real estate and you have loss, that loss gets suspended. But if you qualify, if your income's below a certain level, you can actually reduce your adjusted gross income if you have actively managed real estate. Another workaround that rule is if you are considered a real estate professional and there's ways to qualify as a real estate professional, then you can actually circumvent that income limitation. But that's generally the only way these days to lower your adjusted gross income, other than what we've already talked about through 401ks, 403bs, HSAs, flexible savings accounts, et cetera.
Yeah, and I recall on a couple instances, people have asked very similar questions, and I sort of assumed because they were asking it that they were max funding their 401ks, but then when I checked, it was like, oh, you're not even putting in the full 19.5 or 26 yet, right? So that just don't forget the basics, right? Make sure if you're looking for ways to defer income, right, lower your income, make sure you're getting that. If you're under age 50, putting in the full 19.5, or if you're 50 and over, putting in the full 26 if you can afford it. All right, so I'm sure no one in this call would ever make this mistake, but it is one of the common kind of missteps that we see periodically is not reviewing and updating beneficiary designations. Now, specifically within the employer benefits, right, would be the 401k plan you name beneficiaries on, and any life insurance coverages, right? And by 401k, as Alp talked about, right, that could be 403b, it could be your TSP, it could be a 457 plan. So any retirement plan, you name beneficiaries, right? And so we have seen instances where folks, maybe they have old 401k from previous employers, or maybe it's still their current employer and they've been there for many, many years. But when they look at it, they see, oh, shoot, you know what, I filled this out before I was married and it still names my sibling, or I filled this out before I had kids and it doesn't even name my kids, or God forbid it still names an ex-spouse. We have seen that before. So again, don't miss some of the basics, right? So be sure to review the beneficiary designations on all employer-sponsored retirement plans, all life insurance plans, right? Whether it be through work or your own, and of course your individual retirement accounts, IRAs have beneficiary designations. If you have annuities, they have beneficiary designations. So be sure to keep a look on theirs keep a lookout for those. And I will add, hopefully this is a reminder for folks, is that beneficiary designations supersede your will. Okay, so we do hear this periodically where folks say, "Oh yeah, my will is good. It says that everything should go to my, my spouse, for example." But if the beneficiary designations don't say that, the beneficiary designation supersedes. So it's going to go to the person or persons named on the beneficiary form.
Jason, any recommendations when people have, I'll say, a second marriage and there's kids from both marriages?
Yeah, the recommendation is review it, right? Take a look at it and make sure it's the way you want it to happen. But there's no, I'll say, exact answer for all situations. But in some cases, right, they may say, oh, you know what, I'm going to get a trust, and I'm going to name a trust. Work with an estate attorney. I'm going to create a trust that might say, hey, if something were to happen to me, my assets, whether it's through a beneficiary designation or otherwise, will go into this trust. The trust says, hey, I want my surviving spouse, maybe in Alp's case, right, this is a second marriage, I want my surviving spouse
I'm
to
still
be.
on that first marriage, Jason. I want to throw that out.
Oh.
I know you don't.
You
I'm
are
just joking.
the example you gave.
I'm
Yes, thank you.
kidding.
Yes, Alp is still in his first marriage. But the trust says, hey, I want my surviving spouse to be protected, right, while he or she is still alive. But then when they're gone, it to go to kind of my kids from my first marriage, right? Or maybe that's the only kids in that example. So that's where you want to think about sort of next layer, and things do get a little bit more complicated when you get those kind of blended family situations, and that's a common example of where sitting down with an estate attorney and having a trust in place can work for you.
Yeah, I'd say really it takes a little bit of extra work to make sure you are accomplishing what you want to happen with the
Yeah.
beneficiary designations.
And just one other quick comment, and I know we're coming up here on the home stretch for today's presentation, but is on beneficiary designations, you have a choice of making what's called a per capita designation or a per stirpes designation, right? So per capita basically means like per person, per head, or per stirpes sort of means like by lineage, per line. And so what that means in practice is, if let's just say I'll use my family as an example. I have one sibling, a sister. She does not have any children. I do have children. My parents might say, okay, if they want 50% to go to each of us, that's simple enough. But if something were to happen to me, they might say, oh, hey, I want Jason's share to go per stirpes. I'd want it to go to his kids. Whereas with my sister, if something were to happen to her, they might say, oh, she doesn't have kids. They would like her share to then roll over to me, right? Just as an example. So that's where, like if you're naming kids and if there are grandkids, you might say, oh, I want it to be per stirpes because I'd want it to flow down to the grandkids. Other folks take the perspective of, hey, I just think one level down, and if something happens to any of my kids, I just want it to go to the other kids. Right? So just something to be aware of. Just a few other common benefits. After-tax plans. Alp talked about Roth, right? The money goes in after tax into a Roth. There actually are some other, I'll say, they are more of the traditional, but you don't get the deduction for going into. I'm going to save details on that. If anybody wants to talk more, we can follow up on that. Student loan repayment is something that we're seeing kind of become a little bit more popular. As we know, there's huge amounts of debt related to student loans. So some employers are starting to institute, kind of making it a part of sort of the payroll deduction plan. Some employers even kind of helping with student loan repayments. Education reimbursement. Some employers will help pay for, master's degree, for example, things to be on the lookout for. But one of the things I did want to touch on is for federal employees who may be eligible for the federal long-term care insurance program. Okay, that is actually a partnership that the federal government has with John Hancock, which is just one of the private insurers to provide long-term care insurance coverage. And really kind of the specific added benefit there for anybody employed by the federal government is, if you first get employed, there's a really nice benefit for 60 days where you have abbreviated underwriting. Okay, so if you maybe have some health issues, that's a window for you to get coverage, right? Or if you are, if newly married spouses to a federal employee have that kind of limited underwriting period of time. So something to keep in mind for long-term care insurance. A few things to kind of keep in mind think about when switching jobs. So, things to be careful about are overfunding of a 401k or HSA, for example, right? So if you had payroll deductions, right, from a previous employer going into a 401k for part of the year, then now you go into a new plan. You do want to make sure the combined deductions, right, the combined savings don't exceed the annual limits that we've talked about, right? Same sort of logic with 401ks and HSAs in that example. I talked about having proper insurance coverages, right, during the transition, health insurance, right, thinking about COBRA coverage, and so forth.
And
And
I'll
don't
say on that one thing on the 401ks, that is something that automatically gets picked up by the IRS if you've overfunded it.
Gotcha. Yep. And don't forget to use any money in an FSA that Alp talked about earlier if you're switching jobs. Um, and thinking about coordination with a spouse, right? Thinking about benefits. Obviously, health insurance is a big one. People think, you compare, hey, if we both have employers who offer health coverage, which one might be better? Maybe for the whole family, or maybe you keep them separate. And one of you enrolls in the high deductible health plan, and one has a regular coverage plan. One sort of simple item that we see, back to Alp's earlier comment around free money, hopefully everyone on this call appreciates and likes free money, is making sure both, right, partners or spouses are capturing the full match, right? So we do sometimes see where one spouse might be saying, oh yeah, one spouse is doing all the retirement savings in their plan and the other person isn't because we need that cash flow. Well, we would encourage you to make sure, well, maybe you lower some of the savings here to ensure that the other person is getting at least the free money through any matching contributions from their employer. And then I'll back to kind of the first thing, right? Review the hierarchy of financial needs together, right? Look at that. I think it's a great sort of simple tool for couples to come together and say, oh, you know what, we're good here, we're good here. Oh, we need to make sure we're covered on our retirement savings to get to our goals, for example, and so forth. So we're good here. I think we're coming right up on the hour. So thank you everybody for joining us. As we mentioned, this is being recorded. We will send it out via email with a handout that goes with this presentation. We have a lot of other workshops that have been recorded that are available. So you can find those on our website, afsfinancialgroup.com/workshops. And here's our team. Feel free to reach out to us if you have any questions on today's workshop or anything else. Alp, any parting words of wisdom? Or?
Just stay safe.
All right. Yeah, indeed. All right. Thanks, everybody. Take care.